This video is going to teach you how to value any business in 5 minutes or less. Just to clarify, the video is longer than 5 minutes, obviously, but once you watch this, you'll be able to value any business that you look at in under 5 minutes using this exact framework. There's a couple different things we're going to cover. First, I'm going to share with you a dead simple formula that makes valuation easy. It can get super complicated and confusing. I want to make it as easy as possible. Next, I'm going to show you how to create over $1 million out of thin air using some of these methods. I'm going to show you a secret weapon that can increase your earnings by more than 200%. The math on this is insane, and it's really, really important to understand, especially if you're thinking about valuation. I'm going to show you why some companies sell for loads of cash and others are virtually worthless, and what you can do about that for your business. I'm going to show you how to pick up an extra $100 million in a valuation, which is wild. The math on this stuff is also really crazy when you look into it. I'm going to show you the secret behind why some industries are worth billions more than others, literally. And I'm going to show you what 8-figure private equity buyers are willing to pay big bucks for. We'll recap it all with a 5-minute business valuation blueprint. This is going to be the exact framework putting all these puzzle pieces together that you can use to value any business, your business, or other businesses very quickly and understand the really key fundamental components that go into that valuation. Here's a quick background on me. I'm not going to read this whole bio. I'm a private equity investor. I've done more than $100 million worth of deals. My name is Matt Bodnar, by the way, and I'm a Forbes 30 Under 30 alum. I've got multiple companies that are in the Inc. 5000, and I've done a lot of transactions. I know a lot about valuation. I've talked to hundreds of business owners, both on the buy side and the sell side, about valuing their companies. And I understand the topic in great detail. And I really want to distill it down because I feel like it's a place where so many people get confused. So let's start with the dead simple formula that makes valuation easy, right? This is kind of the whole shooting match in one slide if you want to digest it, but there's a lot that we cover in here and some really, really cool things you can do to improve your company's value. The valuation equation, which is earnings times multiple equals valuation. We'll talk about that in a second. Earnings is half of that puzzle. EBITDA, SDE, add backs, which are huge and can make a big difference. Multiples, right? What drives multiples? The big factors that do that. The end result of putting all these puzzle pieces together, my promise to you is that by the end of this video, you will have a simple framework that you can use to value any business in 5 minutes or less. So here's the dead simple formula for valuation. There's other ways to do it. There's lots of different valuation methods. This is not going to get you 100% accuracy. In fact, valuation, which we'll talk about in a minute, is an art and not a science, right? So this formula is not going to give you a perfect, precise, mathematical 0.0000, no rounding decimal valuation. In fact, valuation really doesn't work that way. It's an art. It's not a science. You're roughing in a guess. And ultimately, the valuation of a business is really just what two people are both willing to agree to transact on it for. But that said, this equation, earnings times multiple equals valuation, is the fundamental structure that all of this is going to be based around. So earnings, we're going to talk about the components of earnings in a second, but those can be negotiated, they can be gamed, and they can change around. And same thing with valuation multiples, right? Multiples have a massive impact on valuation, and they can also be negotiated or changed, and there's lots of factors that can impact them. So that's the equation. Earnings times multiple equals valuation, but there's a lot to unpack in each of those. Let's start with how to create $1 million out of thin air by understanding the earnings side of the puzzle, right? There are two very common proxies for earnings. You'll see others, but these are the most common in the marketplace. And I'm going to try to make this as simple and digestible as possible. And as a result, I'm not going to talk about every little nuance and subtlety. EBITDA and SDE are the ones that you're going to hear the most. They each have their own advantages and drawbacks. Let's start with EBITDA because it's more frequent, right? So EBITDA is a fancy word, stands for earnings before interest, taxes, depreciation, and amortization. Why do people use this? You hear it all the time. At first, I didn't really understand why this acronym, which is a mouthful, was so popular and so common. The main reason is that EBITDA, it's not perfect, but it's a really good proxy for cash flow. And what do I mean by cash flow? The thing people are trying to solve for when they want to value a business is how much cash does the business produce and how many years am I going to pay for those cash flows? That's basically what the earnings times multiple equation is about. EBITDA is a pretty good, it's not perfect, but a pretty good proxy for the cash a business generates. Why is that? Because it takes out things like interest, taxes, and depreciation, and amortization, which is more of a corner case you don't see as often. But interest, taxes, and depreciation, it takes those out of the equation and makes it so that you're looking at the net income or the earnings of the business on a cash basis. The reason this is so important is because interest and taxes and things like that, while a business might be paying those and they are cash expenses that come out of pocket, a new owner of a company may not have the same loan, right? If you have a loan on a company and you're paying $100,000 a year of interest, and I buy it from you and I don't have a loan on the business, that $100,000 that was going towards interest payments can now go to the bottom line. And same thing with depreciation is a non-cash expense, though there's a whole academic finance argument about whether or not it really is a true measure of a company's cash flow. But depreciation is where you write off, let's say you buy $200,000 piece of equipment, you write that off over 5 or 10 years, but 5 years in, you might be having a $20,000 or $50,000 depreciation expense on your P&L, but that's not actually cash that the business spent. So that's why EBITDA is so critical, and it's really just a proxy for cash flow. It's not perfect, but it's good enough that most people use it. SDE is another one you'll hear for smaller businesses. It stands for seller's discretionary earnings. The easiest way to think about this is it's basically mathematically EBITDA plus the seller's income, the seller's benefits, and any discretionary expenses that they had. So SDE is always going to be a larger number than EBITDA, always going to be mathematically a bigger number. But why would you think about or use SDE? The general rule of thumb is that SDE is for sole proprietor businesses or owner-operator businesses. Generally, a business that's doing less than $1 million of total earnings, usually less than even $500,000 of total earnings, is going to fall into the SDE bucket. Whereas EBITDA is for bigger, more complex companies that usually have a whole team of employees, and it's less of an owner-operator model and more of a true business that has a management team. Now, this is where things get really interesting and the math starts to become pretty fascinating. I want to share with you the secret weapon that you can use to increase your earnings by more than 200% without actually having to change anything in your business. I love this meme because this encapsulates it perfectly, right? We start out with the revenues, there's lots and lots there. Then we go to adjusted EBITDA, which we're going to get into, and it's big and robust and it's a pot full of stuff. And then by the time we get to EBITDA, it's kind of withered away. And then by the time we get to net income, there's basically nothing there, right? And this visually really captures this concept really importantly, which is the power of adjustments. There are many factors that can impact adjusted EBITDA or SDE. And I've seen many deals. And if you start looking at broker sims and deals and you really dig into some of this stuff, I've seen many deals that on paper were losing millions of dollars and yet had a positive EBITDA or a positive adjusted EBITDA to the tune of millions of dollars the other direction. So very common to see things like that because of the power of adjustments. How is it possible? Adjustments, they're also sometimes called add backs, is another term you'll hear for it. The basic rule of thumb, if you're a buyer, you want to try to reduce the EBITDA calculation as much as possible because that shrinks down the total you're going to pay for the business. If you're a seller, you want to try and maximize the EBITDA and make it as big as possible you do that by adding as many expenses back in as adjustments because that will ultimately drive a bigger valuation. To reiterate it again with another great meme, you want to be Jason Momoa here. You want to be the adjusted EBITDA, not the EBITDA, and adjusted EBITDA can make a big difference. So what are adjustments? There's a couple different examples we can look at here to showcase different things that can go into the adjustment equation. There's lots of stuff. Basic things like owner compensation, owner benefits and payroll, rent. If somebody's going to close or move the office that you're in, you might be able to add the rent back in because it's no longer going to be paid. Personal expenses, I've seen all kinds of crazy stuff here. Country clubs, automobiles, family members on the payroll that don't work in the business. That one's really common, especially in family businesses. Travel, meals, and entertainment. I once bought a company that had a condo on their P&L that was owned by the owners, and they had all their expenses and maintenance and dues and everything all associated with a condo that the business was paying. That's a pretty legitimate add back because I wasn't buying their vacation condo in Florida. I was buying their company, right? And so that was something we could add back in to increase the profit calculation. And anything that's not business related that might be in there that somebody running a personal expense through the business. Charitable donations can be another good one. I've seen businesses that have large charitable contributions. You want to make sure you add those back in because the new owner may decide they don't want to make any charitable contributions or they may make them differently. And either way, they can decide what to do with those cash flows, which is what we're trying to get to with an adjusted EBITDA calculation. One-time and non-recurring expenses is another one that has a lot of potential. Legal fees, one-time bonuses, discontinued operations, failed initiatives, bad hires. professional costs associated with selling, right? Accounting, legal, etc., severance settlements, all kinds of different things. A classic one is if you have a new initiative, hey, we launched this new division, we spent $200,000 spinning it up and building out the facility and doing all this stuff. Those are one-time expenses that on a go-forward basis, the new business owner or the buyer of the business wouldn't have to incur. And so one-time expenses are a great opportunity for you to find ways to increase your EBITDA using add backs or adjustments. Now, let's look at the actual math on this, because this is where it gets crazy and you can see some really, really ridiculous numbers. We'll take this basic example company, Family Business Inc., doing $5 million of revenue and $1 million of net income. Same P&L here. We're just zooming in a little bit. Instead of just saying, hey, we had 4 million of expenses and $1 million of net income, I broke it down into what that 4 million is actually comprised of. We've got some payroll, we've got some owner salary, marketing, interest, depreciation. Those go into the EBITDA calculation, some owner perks, and some other one-time stuff. So if we just did a straight line EBITDA calculation, and we don't worry about some of those other adjustments, we would add back in the interest, we'd add back in the depreciation, and we'd get to about 500K of total add backs. So that would take our net income from $1 million to $1.5 million. Just by switching from net income to EBITDA, we've already added $500,000 to this company's earnings. Here's another way of looking at this just visually that I like. I think it makes sense. We take net income, it becomes $1.5 million of EBITDA because we've added 250K of interest and 250K of depreciation. It's a 50% increase in the business's earnings just by switching the calculation. Nothing about the business changed. We just switched the way we're calculating earnings from net income to EBITDA. This is where it gets really, really interesting. If we look at adjusted EBITDA, so we spend a little more time and energy, do a little bit more accounting brain damage, and say, hey, yeah, sure, we've still got the interest, we've still got that depreciation, but there's some other stuff that maybe the new owner of the business wouldn't have to incur as expenses. If the owner has $200,000 a year of perks, let's say they have a box at the football stadium and they've got, their car and all kinds of other things that the new owner of the business wouldn't have to spend money on, we want to make sure we add those back into the adjusted EBITDA calculation. Then maybe there was a one-time thing they spent some legal dollars on. They had a new facility they opened, they spent $200,000 on. They had a one-time bonus for everybody's hard work in getting the new facility open that was $50K. And so we have another $500,000 of add backs in here, which can be pretty meaningful. Just by doing a little bit of extra work on the valuation, we pick up a huge amount of additional upside. Let's look at it visually. The net income goes from $1 million to an EBITDA of $1.5 million, where we just add back in the things that are in the EBITDA calculation, specifically to interest and depreciation, to an adjusted EBITDA of $2 million. So we add back in the interest and depreciation to get from $1 million to $1.5. Then we add back in about 200K of owner perks and 300K of one-time expenses associated with the new project or the new facility they opened to get us to $2 million of adjusted EBITDA. That is $1 million total increase in the business's earnings just by calculating adjusted EBITDA. Nothing changed other than the way we move some numbers around on this P&L, and yet the business is now showing double the profitability, $1 million to $2 million. And here's where it gets really, really crazy. This is the math that blows my mind. If you sell that business at a 5 times multiple, or you value that business at a 5 times multiple, if you just said, hey, I got $1 million in net income, 5 times, great, my business is worth $5 million. Cool. Okay, well, if you just go through the effort of switching to EBITDA, that million goes to $1.5 million at that same 5x multiple. Now that business is worth $7.5 million. That's a $2.5 million increase in the company's value just from switching from a net income calculation to an EBITDA calculation. But if you actually take the time to comb through the P&L and get to the adjusted EBITDA at the same multiple, the multiple doesn't have to change. Now that business is worth $10 million. It's worth double. It's worth $5 million more just by switching from net income to adjusted EBITDA, which is insane, right? If you really understand how to position the earnings of a business, it can have a huge impact on the ultimate valuation and exit price of a company. And this chart shows that $10 million is in fact larger than $7.5 million, which is also larger than $5 million. Very important things to pay attention to. I always like to say, every extra $1 million helps. So that's the earnings side of the puzzle. Now let's get into the multiple side of the equation, right? Coming back to our dead simple formula, earnings times multiple, that's how to think about earnings. Here's where things can get even more interesting and crazy. This is why some companies sell for loads of cash and others are virtually worthless. Multiples are a huge driver of this. They're just as important as the earnings side of the equation when you're trying to nail down a valuation for your business. And there's also a lot to understand and unpack them. So while earnings are one side of the puzzle, multiples are the other side of the puzzle, and they're also critically important. I have a chart here. This is from the Pepperdine Capital Markets Project, their 2023 report. It's a great resource. A link to it's actually in the description of the video too, if you want to go peruse it at some point. But this is a snapshot of businesses across a couple different valuation sections. So under $1 million of EBITDA, 1 to 5, and then 5 to 10 across industries. And you can see roughly what the multiples are for each of these businesses. We'll come back to this chart in a minute, but this is a great resource and a really good starting point when you're thinking about multiples. The real question is, what drives multiples? Why is manufacturing under $1 million worth 4.3 and a healthcare company that's doing $5 million of EBITDA worth 7? What changes that? Because that makes a pretty big impact on the valuation. If you're multiplying something by 4, or if you're multiplying it by 7, that's almost double. That can be millions and millions of dollars depending on the earnings of that business. There's really 3 things that drive multiples. The first is the size of the business, and this is in order of importance. Size is the most important. I'll show you some math on this and how crazy it is in a second. The next is industry. Industry also has a huge impact on a multiple and can be really impactful in terms of driving multiples up or down depending on what industry you're in. And then company-specific factors can also have a big impact on shifting a multiple, and we'll talk about how those play in just a second. This is from the same research report, the Pepperdine Private Equity Buyers Survey, part of their capital markets project, and it shows what multiples are the most common. We talked about different valuation methods and different ways to calculate earnings. As I said, most folks use recast or adjusted EBITDA. It's the most common. Some things trade on revenue, some things trade on EBITDA, and then you get into other sort of miscellaneous ways that things are done. But if you just understand adjusted EBITDA, you're 85, you're 70% of the way there, right? And if you add EBITDA in, you're like 80 something percent of deals priced using this strategy. So it's a pretty good way to think about it. And I think this is just cool data to see that this is the norm in the market of how most things are priced. The element that you have to understand around earnings is that they really exist on a spectrum. So if you look at that chart from a minute ago and it says, hey, manufacturing companies of $5 million of EBITDA trade at a 5x multiple, that's the midpoint. But for a given business, it might trade below that midpoint, it might trade above that midpoint, and there's lots of things that can impact that. So how do we determine whether a business should be on the high or the low side? If we look at the earnings spectrum, the size and the industry set the midpoint multiple. They set where you should be at the middle of the spectrum, but company-specific factors determine where you're going to land on the spectrum. So things about that specific business can determine, hey, this thing is way at the high side or it's really low because it has a bunch of issues and challenges. Let's look at a practical way of applying that. Here's the same valuation chart from a minute ago, and I want to use an example. Let's say we have a food distribution business that's doing $2 million a year in EBITDA. Based on this chart, we say, okay, that's in the 1 to 5 bracket. Wholesales and distributors, 5 is the multiple. So we can set immediately, hey, the multiple there is going to be 5x at the midpoint for this business. So with no other information, we could say, hey, that business is probably worth around $10 million. $2 million of earnings times 5 multiple is a $10 million valuation. But that valuation could swing quite a bit. On the low end, we might have a 3 multiple. On the high side, we might have up to a 7 multiple. So how do we figure out whether this business is worth 6 million, which would be the low end, 3 times 2, 10 million, which would be 5 times 2, or 14 million? That's an $8 million difference potentially on the high or the low side, which is massive. The company is worth more than double if it's on the higher side of the spectrum. How do we figure that out? Well, it comes back to this chart from before. The size and the industry give us the midpoint of the spectrum, but the company-specific factors, which we're going to dig into in detail here in a second, help you decide whether you should be on the low side, the middle side, the high side, and where you want to land on that spectrum ultimately. Let's unpack each of these things. First, I want to show you how to pick up an extra $100 million in a company's valuation, which is wild to me. Size matters the most. This chart is a more detailed version of the chart from before. It's from the same private capital markets report from Pepperdine. But the thing that really blows my mind, and it takes a second to understand this, I'll show you some math on this in a second, why it's so crazy, but larger companies are worth even more even when you account for the fact that they're larger. And I'll show you what I mean by that math in a second. But you can see here on the chart that size is more important than industry. So the biggest difference between companies that are doing between $0 and $1 million of EBITDA, on the low side, you have a multiple of about 4, and on the high side, you have a multiple of 6. That's it. Versus same industry, small company doing 4.3, a manufacturing company doing 50 million of EBITDA is worth a 10 or higher multiple. So the multiple massively increases by size, but industry also plays a big factor. So some of these are trading north of 10, and some of these you can see there's a big impact depending on what industry you're in, right? If you're a distribution business that's doing $10 million of EBITDA, that might price at a 6x multiple. If you're a distribution business that's doing $10 million of EBITDA, pricing at a 6x multiple, a healthcare company might be pricing it an 8x multiple, or a financial services business of the same size might be pricing it an 8x multiple. Well, if that's $10 million of EBITDA, that's a $60 million company versus an $80 million company. That's a $20 million difference of the same size company just for being in a different industry. SDE, which we talked about earlier, for smaller businesses also has the same concept of a size premium. As companies get bigger, the SDE multiple that they trade for typically increases. And this is another way of looking at the multiple spectrum. Instead of being horizontal, it's now vertical. So we can see for a given size, you have, if we had a $250,000 EBITDA business or $250,000 SDE business, you can see if we had a $250K SDE business, it would have a midpoint multiple of 2, a high multiple of 3, and a low multiple of 1.2. And it could land somewhere in the middle there too. But I wanted to showcase SDE because a lot of smaller businesses are going to price off of that. But it also shows you that size makes a big difference. In fact, a company pricing off of SDE on the small side versus the large side is going to be worth a multiple of 2 or 3 times more just because it's bigger. And here's where the math gets really crazy, right? This company will take 2 manufacturing businesses. Company number 1 is a small business that's doing $1 million of EBITDA based on the same chart we looked at a minute ago from the Pepperdine Capital Markets report. That would be a 4.3 multiple, which would give that company a $4.3 million valuation. Now, let's take a much larger manufacturing company, same industry, doing $25 million of EBITDA. That business would have a 9.5x multiple, right? Pulling from this chart right here. That gives it 25 million times 9.5 is $237 million. Now, you're thinking, of course it's worth more because it's doing 25 times the amount of profit, right? It's 25 times more EBITDA. So yes, it's much bigger. But here's the crazy thing. It's not 25 times bigger. It's 55 times bigger, which means that just the size, the fact that the multiple goes from 4.3 to 9.5 adds more than add 30x to the differential in the valuation. Just the multiple makes it worth more than the entire company. And I'll show you what I mean in a second. Let's look at this math right here. It's pretty crazy, right? If you take that same thing and you apply that same manufacturing business with $25 million of earnings, if you took its multiple and made it 4.3x, which is what the small manufacturing business is trading at, that gives it a $107 million valuation. So that company, just by being 25 million versus a million, it's worth about $100 million more, a little over $100 million versus the small company. But when you add in the size premium and you take it from 4.3 to 9.5 multiple, that shift in the multiple adds $130 million more to the valuation. That means that the size premium alone, $130 million, is worth more than the entire value of the increase in size, right? This is a visual way of looking at it in another angle. The fact that larger companies are worth more, not just because you're multiplying a bigger earnings number, but because the multiples get much bigger. And this is how roll-ups work, is when people start buying small companies, they make them into a big company, suddenly the multiple jumps up, and then the value increase is massive. This is a really, really, really important principle to understand. It's one of the major drivers of valuation. And that's why I really want to unpack it and make sure that you're getting these pieces of the puzzle, because this is hugely important. The real question is, why does size matter so much, right? There's a couple reasons. One is availability of capital. There's way more capital for bigger deals. In fact, this chart pulled from the same report shows you basically how difficult or easy it is to get financing for companies of certain revenue sizes. And what you can see generally is that the bigger a company gets, the easier it is to get financing. There's more debt, there's more lenders, there's more people that want to do business with bigger companies. And so it gets easier, but that makes it a lot more competitive. Another reason is if you're a private equity firm and you're buying a company, if you buy a $10 million business or a $100 million business, it takes the same amount of effort to evaluate that company, to go to the board meetings and do all that stuff, but they're going to make 10 times more money on a bigger deal. So all things being equal, why would they waste their time on a small deal when they could focus on bigger deals? And bigger companies are generally considered to be less risky and more stable than small companies. If you extrapolate that all the way out, if you go buy shares of a public company, if you go buy shares of Amazon or Nike or something like that, you can buy ownership in that business today and you don't have to do anything. You don't have to pay any attention. You don't have to worry about it. And they're so large, they have so many entrenched advantages that it's going to be really hard for a company like Amazon to go away, right? If you scale that all the way down to the other side of the spectrum, if you have a company that is doing $500,000 of revenue, and it's a sole proprietorship with 2 or 3 people, that business could easily disappear overnight, right? It could lose a couple of customers, it could be gone, the founder could quit, that business could be out of business basically. Smaller companies are much riskier, and so there's more capital, there's more people looking for deals on the larger side, and that's why they're willing to pay more for bigger businesses. And that's what drives the multiples up for large companies versus small companies. Let's also look at why some industries are worth billions more than others. I want to compare a construction company versus a software business, right? And I'll go ahead and give you the punchline to the joke. A construction business will typically trade for 3 or 4 times EBITDA. Depends on the size, obviously, as we just talked about. But for an average construction business, that's a reasonable multiple for if you're doing maybe $1 million or $2 million of earnings. Whereas a software business will typically trade for 3 to 10 times revenue, not earnings, revenue. They could even be losing millions of dollars a year and still trade on a 5x revenue multiple. Why is that the case? Well, there's a number of reasons that make software much more desirable, all things being equal, versus construction. One is the revenue, right? Construction businesses are highly volatile and they're project dependent. If you're going and building an office tower for somebody, once that project is done, you can't get any more revenue out of that, right? It's done, it's a one-time thing. And people also don't typically go out and start massive construction projects in the middle of a recession. And so the business is really levered towards a recession in the sense that a recession could be hugely impactful and could maybe even result in years of no revenue or little to no projects coming their way. Versus a software company that's revenue is highly predictable, it's contracted, and it's recurring over time. You sign one customer, they keep paying you for years. Now they will have some churn over time, but generally speaking, that's a much more desirable revenue stream. It's one of the reasons software companies are worth more. Equipment, CapEx, and assets. Construction businesses are capital intensive. They take a lot of equipment. You have to go buy excavators and big machines, and that eats up a lot of your profits. Software businesses, there's virtually no capital expense. You copy and paste a piece of code, you add somebody, maybe your hosting expenses go up a little bit, but they can scale massively as a result of not needing a ton of heavy capital investment to keep growing. Gross margins. Construction, you have materials expenses, you have labor expenses that eat meaningfully into the margins of the business. Whereas software, once you have your core team, the business, every customer you add, occasionally maybe you need to add some new engineers, some new support folks, but generally speaking, those businesses can operate at 90% plus gross margins, making them highly scalable and much more profitable. So as a result, construction business, difficult to scale, much more risky, whereas a software business is highly scalable and can grow very rapidly. That's why software businesses trade for revenue multiples versus construction businesses trade for low EBITDA multiples. But you don't have to take my word for it. Here is an industry multiple chart. Now, these are pulled from public companies. This is from NYU's Enterprise Value by Sector report from 2024. But you can see some businesses, financial services companies, can trade for 60 times multiple if they're public, whereas all the way down here, you have these companies trading for like mid-single digits that are doing air transport, oil and gas, rubber and tires, shipbuilding. All of those have the same kind of characteristics that I was just talking about. They're very capital intensive. They're very swingy revenue cycles. Whereas the businesses down on this end, healthcare information technology, REITs, etc., they have very predictable, ongoing, steady cash flow streams. And so, dollar for dollar, they're worth a lot more to be in those industries than it is to be in these other industries. This is the same chart. It's basically a wall of numbers, but it showcases the same idea, right? You can see Oil field services and equipment businesses might trade for a 5x multiple if they're publicly traded. Coal and energy as low as almost 3 times, whereas semiconductors are trading at 30 times, right? And the market average is somewhere, depending on whether you add financial services or not, somewhere in the 16 to 14 range. You can screenshot this, or you can also download my valuation kit in the description below if you want to dig into some of this stuff. But I just wanted to show you this is a great way of seeing how massive an impact industry can have on multiple. Now, let's look at what 8-figure buyers are willing to pay big bucks for. This is the private equity buyers survey from that same capital markets report I mentioned earlier. And I think this is a great look at some of the most important factors: firm size, customer concentration, market leadership, operating performance, industry sector, management team, future prospects, etc. This is what private equity buyers value and whether they think things are unimportant or super important, very important. Couple standouts: customer concentration, one of the most important factors, right? If you look at 6% of buyers think it's of little to no importance, and almost 94% of buyers think it's either moderately important to very important. That alone can sink or kill deals. I'm not going to go through each of these percentages. You can take a look, pause it, whatever, and watch these, but I think it's a really good way of showing you what buyers actually care about. And these are some of the things that buyers care the most about when they're valuing a business. I sliced this another way and added a few things that I think are important that weren't included in that survey to look at a bunch of company-specific factors that buyers are willing to pay up for substantially, right? This chart basically goes through each of these and shows you, we'll just look at management team quality. A low valuation would be little to no management beyond the owners or 1 or 2 key people, whereas a higher valuation would be a robust, fully functional management team. Reliance on the business owner. This is a big one. A low valuation would be the business is solely dependent on the owner working full time, whereas a high valuation would be the business operates entirely without the owner. Customer concentration is hugely important. Quality of financial records, a weak or messy financial statement versus clean and audited financials are going to drive a business either to the low side of the spectrum or the high side of the spectrum. Hard assets, I have an asterisk here. The reason is a business can have no hard assets and still trade for a high valuation. But generally speaking, lenders especially love to see hard assets, and it makes deals easier to finance. And so it can be a really attractive quality of a business to look at if you're acquiring something. I'm not going to go line by line through each of these. Again, you can either screenshot this video or you can download this whole valuation kit in the description below and get access to this chart as well as this, which is the company evaluation matrix. This is how you bridge the gap between the company's value and where it lands on the valuation spectrum. Takes each of those things from the previous slide, each of these independent valuation factors, and it gives you a little chart to plot them across. I'll show you what a filled out one looks like here in a second. Basically, and I just made these up for a random business, right? But you can say, hey, how's the management team quality? Is it high? Is it low? Is it kind of in the middle? How's the reliance on the business owner? How are the quality of the financial records? Are there hard assets or not? Does it have volatile earnings or not? How long have they been in business? Are their gross margins good? All of these different categories are great things you can use to evaluate a business. And I'm going to show you practically how to apply those. I pulled this listing randomly from BizBuySell to give you a sense of just a random deal. This is an accounting and tax services business based in Knoxville, Tennessee. They're asking $1.5 million for it. It did $544K of cash flow. It had 600 odd of gross revenue, and it has FF&E of $5,000. That just stands for equipment, basically. So hard assets. Not a lot of hard assets. Other things of note here, it's a home-based business. There's 1 full-time employee. Reason for selling is retirement. Here's a broader description of what their services are. The business was founded in 2011. So let's take this actual CPA firm and really quickly run it through the company analysis grid. Management team quality. There's 1 employee, right? So there's virtually no management team, right? Contrasting that with a business that might have 5 or 10 people just on the management team and 50 or 100 employees, there's virtually no management team quality in that business. Reliance on the business owner. There's 1 employee, and it seems like from my read of the listing that it's basically a 1-person accounting shop, right? So I would say it's extremely reliant on the business owner. What are the quality of their financial records? Well, I haven't gone through them, but initially, given that it's an accounting business, I'd wager they're probably reasonably high, right? So we'll give them there. And if we go back and look and they're super messy, maybe we would update that and reduce it down the road. Customer concentration, Haven't gone through their customers, but given that it's a small business doing about $600,000 of revenue, I'd say there's probably some moderate concentration. If we came back and really went through their numbers and said, hey, it's actually either super high or super low, I would adjust this in my valuation analysis. Hard assets, they have $5,000 worth of computers and tables and stuff, right? Virtually no assets. Volatility of earnings. The earnings seem, I would guess, are pretty non-volatile. If it's an accounting business, people are paying for their tax returns annually. They're paying for their bookkeeping on a monthly basis. It's a pretty consistent business, so the earnings are probably not super volatile. Growth opportunities, I pegged kind of moderate, right? We don't know for sure without getting in there. Everybody needs accounting, but also lots of people already have accountants. And most people, any business that's operating probably has some accounting function that already exists. So the growth opportunities are potentially there, but they may not be super compelling. Recurring revenue, that's probably on the higher side. Again, people are doing their taxes on an annual basis. They're paying for bookkeeping on a monthly basis. So that's a pretty recurring business model, which is something I like about this business. Customer acquisition cost, most folks already have a CPA. And so they're probably in the mid to high side. Without really unpacking it, I don't know for sure, but I can take a reasonable guess just based on the business. Brand awareness, there's virtually no brand awareness, right? It's a small 1 or 2 person CPA firm in Knoxville, Tennessee. I've probably never heard of it. You've probably never heard of it, and it has virtually no brand identity at all. Length of operating history, it's been around for 11 years, which is pretty good. I like to see at least 5 years in business. 20 plus is awesome, and 11's pretty solid, so I kind of rated it mid to high. Seller motivation and urgency, based on conversations with the seller, we might uncover that this is either lower or higher. But initially, given that their reason for selling is retirement, this seems like a reasonable place to ballpark them. Growth rate. Their business is doing $600K a year of revenue. It's a sleepy 2-person accounting firm in Knoxville, Tennessee. I'm guessing it's not growing very rapidly. Similarly, competitive advantages. The business has virtually no competitive advantage that I could see, especially if it's a 2-person show and the CPA who their name is probably on the door and has been running it is selling. They might have been the only modicum of competitive advantage that the business had. Without them, there's virtually nothing there. Gross margin is super high. I'd want to unpack that and understand if that number's real, but based on what the listing said, they were doing about $600K of revenue and $550K of profits, and accounting services generally don't have any hard good costs associated with them, so it's a high gross margin business. And then product diversity, they've got a couple different offerings, bookkeeping, tax services, etc., but I'd put them at kind of the low to mid point on the product diversity grid. So coming back to this accounting and tax services businesses based in Knoxville, here's a snapshot of the listing again. How do we value this business? Let's go through our whole valuation framework that we've talked about in this video. First, is it SDE or EBITDA? This business is basically a sole proprietorship that has very few or maybe 1 employee, no management team. So I think pretty clearly we would be using SDE to value this business. Here's the SDE chart from earlier. They said the business is doing about $500K of SDE. And so the midpoint there would be a 2.5 times multiple, right? We're going to the chart. We're using the size to get about 2.5 times. And if we just took the $544K of SDE, multiplied it by 2.5, that would get us to about a $1.36 million valuation for this CPA firm. Now, the real question is, should we actually be at the midpoint, right? Now, that's why we went through that whole company analysis matrix to figure out where do they land. Now, some of this is subjective, and I've done this a lot, so I can give a pretty good assessment on my own, but I would say based on all these factors, especially no management team, heavy reliance on the owner, no real competitive advantage, no brand awareness, probably not a huge growth rate. Given some of those factors, I feel like a 2x multiple would probably be where I would land for this business if I wanted to purchase it. I think 2x is a little more reasonable than 2.5 or 3. And so 544K of SDE times a 2 times multiple, I would value this business around $1.08 or $1.1 million versus their $1.5 million asking price. So where does that land our little accounting business in Knoxville? I think it's overvalued, right? And in fact, I wouldn't be surprised if that listing sits on the market for a while and doesn't trade, because I don't know many folks that would be willing to pay 3 times for a business that they're basically purchasing a job. So that kind of ties everything together. Let's wrap this up with a 5-minute business blueprint. This is bringing everything we talked about back into the exact framework you can use to value any business in under 5 minutes. We start with the dead simple equation. Earnings times multiple equals valuation. On the earnings side, You got to pick whether you're using EBITDA or SDE based on the size and complexity of the business, then calculate it. You can start out with net income, but you want to make sure to go through and include as many adjustments and add backs as possible to increase that earnings number, especially if you're selling the business. Then you select a multiple, determine the company size and the industry to set the multiple midpoint. Then, based on the company evaluation matrix, which is that thing with all the different factors, decide where you should be on the spectrum. That's it. You get the midpoint, you decide where you want to be, and maybe you end up right there. That's all it takes to value a business. It's a complicated and confusing topic, but once you break it down, this is a dead simple way that you can take any company and value it in 5 minutes or less. Thank you so much for watching this video. Hopefully this gives you a great framework that you can use to value any business in 5 minutes or less. If you want to download the resources I talked about here, there's a valuation kit that you can download in the description of this video, and links to all of the third-party resources that I mentioned, the surveys and reports, etc., are available in the video description as well. I hope you enjoyed this. If you like this kind of stuff, check out the other videos on my channel where I talk about buying businesses, valuation, and doing deals. Thanks again for watching, and I'll see you on my next video.